It has officially begun. The desperate final act of a dying empire just played out on the charts, and if you blinked, you might have missed the most important signal in 40 years. Yesterday, at exactly 8:30 a.m. New York time, the bullion banks declared war. They didn't use press releases, they used leverage. As silver touched the critical $85 level, a massive coordinated sell order hit the COMEX. We are talking about billions of dollars in notional paper silver dumped into the market in milliseconds. It was a limit-down attempt. It was designed to shatter confidence, trigger stop losses, and send the price crashing back to the safety of the 70s. But something historic happened. Something that hasn't happened since the Hunt brothers in 1980. It didn't work. The price didn't collapse. The red candle appeared, yes. The algorithm tried to paint the tape, yes. But instead of a panic sell-off, the market simply opened its mouth and swallowed the liquidity. The dump was absorbed, instantly. Within minutes, silver was trading back at $84.80, and then it ripped right back through $85 like a hot knife through butter. This is the moment the Maginot Line fell. For years, the banks have relied on the smash to control the price. They rely on the fact that when they sell, you panic. But today the psychology broke. The paper shorts dumped their ammunition, and the physical longs stood their ground. This wasn't just a failed trade, it was a suicide mission. By dumping that much paper at $85 and failing to crash the price, the banks have just exposed their jugular. They are now naked short in a rising market. They threw their best punch, and the market didn't flinch. What we are witnessing is the commercial signal failure. The machine that suppresses the price has jammed. The gears are grinding. The algorithm is confused because the input, dump 5,000 contracts, did not result in the expected output. Price drops $3. Instead, it triggered a feeding frenzy. The smart money, the sovereign wealth funds, the Asian industrial giants, the stealth whales, saw the liquidity spike not as a reason to sell, but as a gift. They used the bank's own selling pressure to fill their buy orders without spiking the price to $100 immediately. The banks effectively subsidized the accumulation of their own enemies. The panic sell at $85 backfired because the market has transitioned from a speculative phase to an accumulation phase. In a speculative market, price drives sentiment. In an accumulation market, shortage drives sentiment, and the shortage is screaming. The silence of the banks this morning is deafening. They know what just happened. They know they just lost control of the thermostat. The suppression era ended the moment that dip was bought. Why $85? Why did they panic specifically at this number? To understand the violence of this move, you have to look at the gamma wall. The $85 level was the kill zone for the options market. The commercial banks had written massive amounts of call options with an $85 strike price. They collected the premiums, betting that silver would never, ever cross that line before expiration. If silver stays below $85, they keep the money. If silver crosses $85, they are on the hook to deliver millions of ounces of metal they do not have. When the price approached $85, the gamma exposure went vertical. They faced a mathematical certainty. If they didn't cap the price, they would be forced into a gamma squeeze. This is where the market maker is forced to buy futures to hedge their losing options bets. Buying futures drives the price higher, which forces them to buy more futures. It is the doom loop for a short seller. So they tried to break the loop. They panic sold futures to defend the $85 wall. They tried to create a liquidity flush to drive the price down and make those options expire worthless. It backfired. By dumping futures, they added to the open interest. They created more paper claims on silver right at the moment when the physical market is tightening. Now that the price has reclaimed $85, those new short positions are underwater. They didn't just fail to stop the gamma squeeze, they added fuel to it. We are now looking at a double squeeze. The gamma squeeze. The options dealers must buy to hedge. The short squeeze. The banks who dumped yesterday must buy to cover their losses. This is the recipe for a vertical melt-up. The $85 level was supposed to be the ceiling. It has now become the floor. In technical analysis, we call this a polarity flip. Old resistance becomes new support. And when resistance this strong breaks, the energy release is explosive. The algorithm knows it is trapped. That is why we are seeing this insane volatility. The computer is trying to find a way out, but there is no exit. The door is jammed with physical buyers. The banks are like a pilot trying to pull up, but the controls are dead. This $85 failure is the signal that the paper derivative market is decoupling from reality. They can print contracts, but they cannot print the metal to back them, and at $85 the market is demanding the metal. Why did the smash fail? Why didn't the price crash like it did in 2011 or 2020 because of Shanghai? While the New York banks were hitting the sell button, the Shanghai banks were hitting the buy button. We have talked about the arbitrage gap, the price difference between the West and the East. Right now, silver in Shanghai is trading at a massive premium to New York. When the banks dumped silver at $85 in New York, they effectively put silver on sale for China. They made the arbitrage trade even more profitable. A trader could buy the cheap paper silver in New York at $85 and sell the physical contract in Shanghai for $90 or $92. This is the Shanghai put. It is the floor under the market. The Chinese importers are standing there with buckets, catching every single ounce the West throws away. The banks in New York are trying to play poker, but China is playing Go. China is securing the resource. We also have to look at the backwardation signal. The spot price is currently trading higher than the futures price in the nearest delivery months. This is the market screaming for immediate delivery. Usually when banks dump paper, it scares the physical buyers. They wait for lower prices. But yesterday the physical buyers didn't wait. We saw reports of loadouts accelerating during the smash. The industrial users, Samsung, Tesla, the solar giants, they used the liquidity event to fill their order books. They know that the just-in-time supply chain is broken. They are shifting to just in case. If silver dips to $84.50, they don't see a bear market. They see a discount on a critical component that keeps their factory running. The banks are fighting a war on two fronts. Front 1, the speculators and the gamma squeeze. Front 2, the industrial vacuum and the Shanghai drain. They cannot win this war. They ran out of physical ammo years ago. All they have left is paper, and yesterday proved that paper no longer scares the market. The fear trade is dead. The greed trade has begun, but it isn't greed for dollars. It is greed for ounces. The dump at $85 was the last stand. They threw the kitchen sink at us and we caught it. Now let's visualize the consequences of this failed smash. What happens to the supply chain when the paper price tries to suppress a physical explosion? We enter the unobtainium phase. The banks tried to tell the world that silver is worth $85, but the physical market is starting to say, we don't care what you say. Go to a dealer website right now, look at the premiums. Did they drop when the price dipped yesterday? No, they likely widened. Dealers are terrified of replacement costs. If they sell you a coin at $88 based on the spot price, and then the price gaps to $95 on Monday, they lose money. They cannot replace the inventory, so they widen the spread, they jack up the premiums, or they simply stop selling. We are hearing rumors of force majeure whispers in the wholesale market. Refineries are struggling to source 1,000-ounce bars. The miners are not selling. The miners are holding back supply, waiting for higher prices. They see the desperation of the banks. Why sell at $85 when the bank is trapped and will have to pay $100 next week? This creates a supply strike. The $85 panic sell has effectively frozen the flow of metal. No rational seller wants to part with real silver at a manipulated paper price that just failed to hold. Imagine being a procurement officer for a solar company. You saw the banks try to crash the price and fail. What does that tell you? It tells you the floor is concrete. It tells you the only way is up. So you panic buy, you double your order, you call the refinery and say, I don't care about the price, just lock in the volume. This exacerbates the shortage. The harder they try to suppress it, the faster it disappears. We are approaching the point where the spot price becomes a ghost number. You will see $85 on the screen, but if you want physical delivery, the price is $110. If you want it now, the price is $120. The official market and the real market are divorcing. The banks have inadvertently accelerated the timeline. By trying to stop the rally, they prove the rally is unstoppable. They remove the doubt. So, the banks are trapped. The physical is vanishing. The unobtainium phase is here. How do we play this? We play the minor pivot. If the banks are forced to cover at $90, $100, $110, the profit margins for silver miners are going to go parabolic. At $85 silver, a miner with a cost of $20 is making $65 pure profit per ounce. Wall Street hasn't done the math yet. They are still treating miners like distressed assets. But when the Q1 earnings hit, when these companies become cash flow monsters, the stock prices will re-rate violently. The failed smash at $85 confirms that the floor for the miners is massive. The downside risk is gone. The banks tried to crash it and couldn't. That means the miners are printing money. We are moving capital into the unhedged miners, the ones who didn't sell their soul to the bullion banks, the ones who have leverage to the spot price. This is where the 10x gains are hiding. While everyone fights over physical coins with high premiums, the mining stocks are sitting there, undervalued and unloved, ready to explode. And we must watch the gold to silver ratio. With gold at $4,500 and silver at $85, the ratio is near 52:1. It is crushing down. The target is 30.1, then 15.1. The ratio strategy is the only exit plan that makes sense. We are not selling silver for fiat currency that is being printed into oblivion. We are swapping silver for gold when the ratio screams overvalued. When the ratio hits 15, we trade the volatile silver for the stable gold. We lock in the purchasing power. We let the banks fight over the scraps while we walk away with the king of metals. But we are not there yet. At 52.1, the trade is still accumulate silver. The squeeze is still young. The banks are still solvent, barely. We ride this until they break completely. Here is the verdict on the panic sell at 85s. It was the death rattle of the paper cartel. The banks fired their biggest cannon. They used their algorithm. They used their leverage. They used their ghost week tricks. And the market laughed at them. The 2.9 million ounces we saw vanish recently was the prelude. The failure to crash the price at $85 is the confirmation. The emperor has no clothes. The Maginot line has been breached, and the tanks are rolling through. If you are holding physical silver, do not let the volatility shake you. The swings will get bigger. We might see $5 moves, $10 moves in a single day. This is what a currency crisis looks like. This is what a short squeeze feels like. It is not a straight line. It is a violent repricing of reality. The banks are trapped in a room with no exit, and the water is rising. Every time they try to sell paper to bail themselves out, the water rises faster. Do not sell your ticket. The show is just starting. The wealth transfer is moving from the paper asset holders to the hard asset holders. You are on the right side of the trade. The dump backfired. The squeeze is on. The target is $100, and then the blue sky beyond. Subscribe to the channel. We are tracking the Gamma Wall and the Shanghai Premium every single day. You need to know when the next desperation move is coming so you can profit from it. The banks panicked. We prepared. Hold the line. Class dismissed.